All right, welcome everybody to Midas Investing Live. Here we are again, Sunday afternoon. Hope you guys all had a pretty good week. I know I did. It was definitely a pretty fun week. Got 0.25 on time for everything. Oh wow, I guess we got a few guys here ready and waiting. What's the 0.25 mean, Jack? What's that in reference to? I have to ask. But anyway, so here we are. I will say for anybody who joins live or on the replay, we really appreciate it if you give the stream a like, help us with our algorithmic overlords. Oh, rate hike, is that's oh yeah, I guess I should have been I guess that would make more sense. I don't know why in my mind I was thinking like returns or something. I thought maybe you were like telling me you had like 25% returns or something. I was like, what? I don't know. Just my mind in a weird place. 25% basis point. We'll certainly get to that discussion. I'd say I'm probably in that camp too, but we'll get to my overall thoughts on that. Anyway, as I said, please like the stream if you're here live or on the replay. Subscribe to the channel if you're not already, and all that. Also consider joining the free Discord. The link is in the description below. Also consider supporting the channel. Links for that are also in the description below. Also, I will say for people who also watch on the replay, if you didn't catch my video that I put out this week, my stock analysis video on F&G annuities and life, I would highly recommend people check that out. I honestly think it was one of the best videos I've made so far. I put a lot of work into building the thesis around that overall company and the industry it's in, and I think I put a pretty good job of putting the model together for that. I'm super excited about that opportunity, I'm not going to lie. It's still one of my smallest positions, but I'm not going to lie, I think it has the potential to become one of my top positions over time. So we'll see about that. Obviously, what with it having a very large unrealized losses portfolio like a lot of other companies right now, there's a lot of reasons why plenty of people are discarding their shares of it. Not to mention it is obviously a recent spinoff, so it's like there's lots of reasons why I think it's cheap, and it may continue to be cheap in the short run. But yeah, the more and more I look into that industry, the more excited I get about it. The demographic trends is something I've really been well aware of for a long time, but it was really just trying to find the right way in a seemingly non-high risk way to capitalize on it. But yeah, definitely check out the video if you guys haven't checked that out. Obviously, I assume the guys who are here, as Jeff said, he already checked it out. So it's like, yeah, probably the people who are here live are probably more likely to have watched it maybe. But if you're watching on the replay, definitely check that out. I'm thinking about a bucket of FN, JXN, and one more to play the market. Yeah, I did see your comment about Jackson Financial, and I'm definitely trying to put together a list of other companies in the annuity space. There's plenty of little like similar company lists other people you can find online. You can just look at the life insurance industry kind of groupings as a whole, as well as the article that I talked about in that video, the S&P article. I talk about lists a whole bunch of other annuity companies. So yeah, I've been kind of compiling a list of similar like companies to take some kind of comparable metrics for it. As I said, the reason why I ended up with FG is really just a matter of inheriting those shares from FNF. And so, in some ways there's a little bit of a bias to that pick just because of that. It's possible that Jackson Financial or one of the other ones, FN, like you mentioned, could possibly be in a better position for it. But I will say, also part of my thesis surrounding FG is the fact that they are such a small player within the market, and that they're attached to a much larger player within a separate market, but a market that nonetheless gives you good relationships with customers. So it's like part of the thesis is that that's the reason why they will be able to actually expand their market share probably better than others, because otherwise it would be like the big market delusion, where it's like, well, of course in a growing market the market's going to grow, but the question is how much per company is going to grow if the industry is really fragmented. OFG, so FN, I guess you're saying is not a separate one. Yeah, I definitely didn't recognize that name, so I wasn't too sure what you meant there. Excuse me, I had a hairball there in my throat. So anyway, I also pulled up in here the model portfolios. As you can see, I did actually finally make time this week to get the dividends listed in here for the companies that have paid out dividends so far here in 2023, which, you know, altered the returns a little bit for a few of the companies. I was curious to see on net how that affected things, because obviously some of the companies in the lower half affect my model portfolios in kind of a negative way, depending on which direction the returns go. But overall, it actually added a slight bit to the overall return. However, I would say that the overall net of bias outperformance has come down pretty significantly over the last week or two. For the returns of all three of the portfolios sample are netted out against the equal weight portfolio. The overall excess return has basically disappeared, as well as the S&P 500 total return has jumped up to 2.4% for the year, while the average model portfolio is down to less than 2%. So they actually have the model portfolios are starting to perform less as impressively as they were for like the first 2 months of the year so far. WSM's last dividend increase 15.3% puts it over 3%. I'm stoked. Yeah, you know, I still very much like that company, and definitely have thought about it in the recent past a little bit about maybe taking another look at it at some point. Definitely interested in that. The CONF call was pretty average, strong Q4 results, but soft November and January so far, hoping it keeps falling so I can get more. Yeah, that could be pretty good. Oh, conference call. I thought that was a ticker for some reason. My brain is like weird today. I don't know why. I had weird sleep last night. Need to drink more coffee. So, getting to the Federal Reserve a little bit. We'll talk about that. Obviously, Jack threw in his pitch for 25 basis points, and you know, I'm definitely probably mostly in agreement with that. Here, coming over to the CME group, where they have the Fed futures probabilities implied for a curve right here. The current expectations, according to the market, is about a 62% chance of 25 basis point hike. It seems pretty much like all the market participants have discarded the notion of a 50 basis points, and now it's really just more between 25 and 0 for the most part. And then it seems like there is a forecast for that basically to be it, for it to go flat in the next meeting after that. And then at that point, it seems like the market is forecasting declines thereafter. I'm as per usual, I'm not necessarily in agreement with the market. I mean, that's kind of the general theme of everything about me in markets, is I generally don't agree with them. I just think they might be on the right course. I think there's a good chance this kind of downward movement might get pushed back outward, despite all the troubles we've had in the last few weeks. I don't necessarily think that the Fed is really actually pivoting yet. I could be wrong on that, and I've somewhat positioned myself a little bit for this week for that risk, for the potentiality that things are wrong. As I talked about in the last week call that we had here, the last discussion we had, I talked about my hedging position with options, which depending on how the market would react to such a news, could definitely be heavily affected. If the market were to react rather positively to the idea that interest rates are going to come down, well, then that's obviously going to be a pretty solid boost to the market in that short run. I think that would be kind of a misguided reaction for the market, personally speaking. It's like, you have to kind of think about this. It's like, what is the reason why the Federal Reserve would be cutting rates? Everyone's just thinking about the rate going down, and that means the discount rate's going down, and therefore asset prices get lifted. But if the rate's going down, it's inherently because there's a risk to the cash flows. Otherwise, they wouldn't be cutting rates in the first place. They would keep moving with the course. So if the discount rate's going down and that's going to raise your price, that's fine. But if the cash flows also come down, well, then the asset price also comes down relative to that, at which point it becomes a balancing act between the two. So like personally, if rate hikes are coming down, I don't see that as a bullish sign for the market, despite what the market seems to perceive those things at. But yeah, so I mean, if you do come over to the Federal Reserve balance sheet, I did put it in the thumbnail, somewhat of a clickbait title, but also I was kind of like laughing a little bit at just kind of the way people are reacting to a lot of this, because of the financing facilities that the Federal Reserve has put in place here for the companies that are experiencing financial stress. The balance sheet did shoot up here in the last week, taking us back to the levels that we were at back in November or so of last year. So basically erasing about 3 months worth of the tightening process in terms of the balance sheet action, obviously, because most people have been focusing on the interest rates, but they have been decreasing the balance sheet as well. In fact, in some ways, you could probably argue that the decreasing of the balance sheet is more important to the overall tightening process relative to the interest rates. That's at least my perspective. Personally, I think that like they could have chosen to leave the interest rate at maybe some sort of moderate level and just like hold it there, and then focus a lot harder on selling off the balance sheet. Because really it's the combination between the two that is the overall tightening in the system. My preference would have been to do something like that. Maybe, I don't know, maybe leave like the Fed funds rate at like 4% or something like that. And then like once they'd gotten it to that kind of relatively solid level, then they probably could have just sold off assets much, much, much harder, in my opinion. And that would have effectively had, theoretically, a similar effect on inflation. Which I will say, the fact that they maybe are reversing course now and maybe coming to a loosening period, like I said, I'm not so convinced that's actually true, but let's just theoretically argue for a moment that maybe we are actually going back to loose monetary policy. We've already seen it on the balance sheet. Maybe we'll start to see it in the interest rate this week. If they choose not to increase interest rates, then you could theoretically call that a loosening. Not increasing interest rates isn't loosening in terms of a decreasing interest rate, but if the two actions you took that week were neutral interest rate action and then a negative balance sheet action, and that means on net you would say this week you loosened, you know. So that would be my argument there, that going to zero of a move this week by definition would mean that they had loosened monetary policy. You could still argue that it was just a flash and that they would be going back within the next meeting to do so, but the point is, if they don't do 25 basis points, then I'm going to argue right there that they pivoted. But like I said, I do on net still expect 25 basis points. Now, getting to sort of the reasons why I do expect 25 basis points is that I actually kind of think that that's really the safest move for Jerome Powell. Because if he doesn't increase interest rates, like I said, I think a lot of people might come to the similar conclusion I did, that they are effectively loosening at that point, at which point it would be like losing the fight against inflation. So I think he sort of has to keep moving with the interest rate movements regardless of that, because I think this kind of lending facility that they did this week, they think of this as, okay, we'll do this so that we can increase the 25 basis points. And if you come over to, for example, the inflation rate, this is the year over year consumer price index, you can see like where we currently are. It's like, okay, cool, we've gotten down to about 6%, but 6% is far away from 2%, you know, which is their real target. And of course, the measure that they're actually using for their targeting is the PCE excluding food and energy, which is currently really around like 4.5% or something like that. So it's like, you know, whatever. The point is, either way, they're still over double away from where they're supposed to be. And like the CPI is currently only back where it was in about September, October 2021 kind of time frame, and which was before the tightening even began. So as you can see, like the whole tightening process began technically in like February, March, but the market effectively started self tightening after December and into January. So at that point, you can see the inflation measure still continued to move up. It didn't even start to move up until almost the way through 2022, after we'd gone through a lot of that tightening process. So yeah, it's like all this effort and they've barely moved the needle. And so I don't really think he has a choice but to do the 25 basis points. Otherwise, he loses basically all credibility. What do you think is more destructive to the economy, rates or QT? I'm leaning towards QT. Well, this is kind of what I was saying here, is like, I assume by QT you mean the lowering of the balance sheet. Because I consider the lowering of the balance sheet and the interest rates all part of QT, in my opinion. It's like, effectively, I consider them really just two halves of the same process. But getting to your question, like you're just saying balance sheet decreasings versus interest rate increasings. Yeah, I would say I probably agree with you on that, but that's part of the reason why I think they should have focused on it a little bit more. Rather than increasing the interest rates a whole bunch. And to me, it feels like they felt like they had to increase the interest rates to a certain point, almost like ripping that band-aid off, where in my opinion, they should have tried to let the interest rates continue to be just moderate. Like I said, like maybe bring it to like 3 to 4% or something like that, get it up above the target inflation area. See, that's why I say 3 to 4% or something like that. So if you're targeting 2% inflation, get the interest rate to where after your interest rate after CPI comes down to your target range, now you're in a real interest rate territory. You didn't have to chase it all the way up, in my opinion. You just need to get it to a place where in the end, it'll be where you want it to be. And then at that point, in my opinion, they should have focused on the tightening. And yes, it's partially because the tightening is, I would say, harder for the economy to take in certain circumstances, but it is kind of hard to say for sure, because it comes down to the assets that are actually in this balance sheet right here. The actual composition of this is like 60 to 65% government bonds or something like that, but then it's like 30% mortgage-backed securities. So really, it's getting rid of all those mortgage-backed securities, in my opinion, is both the more destructive part of this, but also the part that needed to get done fastest. Like really, like the dream, in my opinion, I don't even care almost about the interest rate. I care almost infinitely more about getting rid of the mortgage-backed securities, because then that would return the housing market back to like an actual normal once it recovers. Because yeah, obviously selling it off would have been very, very destructive to it in the short run. But the point is it's kind of both. It's kind of both. Like I said, it's like it's all part of one process. Raising the interest rate sucks money out of the economy. Either way, like that's, and selling these assets back into that market, it still has the similar effect. And either way, it tightens. So yeah, I don't know. I'm definitely expecting 25 basis points this week, but well, we'll see. It's not impossible that they choose to choose 0. I actually did hear some decent arguments about why 0 could maybe be a better choice. And like I said, in my opinion, I feel like 25 basis points is kind of like it's when I say safest choice for Jerome Powell, I don't even mean economically. I mean kind of like reputationally when I say that. It's like relative to like all of his past statements, you sort of have to keep the course, you know. And they kind of have, they're like the Wizard of Oz, you know. So it's like they kind of have to put on this show and pretend like they've got everything under control and everything's going according to plan. So like, for example, if he was to come out this week and switch to 0 after giving a super hawkish speech in front of Congress that made everybody think he was going to go 50, at that point, it would just look like you're whipsawing back and forth and don't have any idea what's going on in the economy. Whereas if he does 25 basis points, he can kind of argue, it's like, oh yeah, you know, Silicon Valley, Silvergate, all the others, First Republic, oh yeah, all the regional banks crashing. Yeah, that's bad, but it was kind of within our expectations. You know, like that's sort of the show I think he has to give on. Not that they thought those specific banks were going to happen, but the point is we all knew pain was going to happen, right? So the point is he can't react to the first feelings of pain without basically completely giving up the show. So I think he basically has to go 25 basis points as a result of that. It's the only way to keep the show on, at least for the time being. I agree with the statement that if the Fed is cutting rates because of SVB and SBNY, then we have a big problem. Yeah, well, I mean, yeah, that, and exactly. And that's the thing, is like, I think they would rather keep the rate movement going because that's the thing people are kind of focusing on the most, and then just set up the lending facility for this, which, you know, it's a lending facility. It may not be the end of the world. The Federal Reserve has created all sorts of special facilities for companies to borrow from them. They did this back in 2008, 2009 as well. They did this in 2020. These programs have typically forecasted kind of the early return to a looser policy. I would say, for example, back in 2019, when we were having the repo crisis that was kind of happening, you know, they had been lowering the rates, or not lowering, they had been raising rates prior to this, and also lowering the balance sheet. As you can see here, they were going through the same process, and then at some point or another, they hit a huge roadblock. That was a huge problem for the market, and everyone was like, "Oh my gosh, this is it. I guess we're going to stop doing that." And then obviously we had COVID, which kind of covered this problem up. So a lot of people half forgot about it, and then even if they didn't forget about it, it just gets completely covered up by everything else that happened since then. And you know, the more conspiratorial argument you can make here is that a lot of the cover up was kind of done because they knew this was actually going to be a crisis in the first place. In some ways, you could say that they sort of used COVID as kind of like a way to say, we got to get this loosening done real quick to kind of patch up this problem we were having here. You know, obviously COVID was already happening or whatever, so I'm just saying they took advantage of a crisis that was already happening. Whatever his name, Rumsfeld, never let a crisis go to waste concept, basically. So the point is SIVB, in my opinion, looks kind of similar to that, where it's like they're trying to go through the tightening process, they're lowering the balance sheet, they're raising the interest rates, they have a huge hiccup here, oh, okay, it's okay, we're just loaning out a bunch of money right here, but we're still going to keep it raising interest rates, don't worry about it. And then the rate cuts happened, you know, here in early 2020. So it's like, I don't know, maybe they'll keep going for a few months. do another rate hike this week, maybe another one in the week after, or not the week after, the month or two after, or maybe the next meeting after that, they'll actually pause, which is what the forecast currently is. And then maybe we will go down. See, like this current path that it shows right here is actually pretty well in line with this story that we had in 2019. So I don't know, maybe that could be the case. All right, so I guess that's pretty much all my thoughts on the Fed. I feel like if I go any further on that, then I'm probably just going to go in circles on it. But we'll see what happens with it. Coming over here to the dashboard, the value dashboard. Haven't added any new companies this week. Obviously was super focused on finishing up the FG video. Last week, I'm pretty sure when I said what I was going to be doing this week, I was originally saying that I was going to be putting out my FNF video. So you can still expect that to be coming in the near future. It was really just like as I was making the FNF video in my mind, obviously it just became obvious. So I was just like, well, why am I doing the FNF video first if like 1/3 of their company is FG, and FG is a whole company itself? It's like how I can't really do the FNF video without explaining FG. So like I just kind of switched halfway through the week. So the plan is to do an FNF video here in the near future. I'm hoping to maybe get it out this week, but obviously I had been switching to more of like an every other week for the valuation videos. So technically I have an extra week according to my current schedule of it, but I'm hoping to maybe rush that one out a little bit, partially because I want to get focused on some of the other companies that I kind of have on the radar a little bit. I have done some kind of like shots in the dark valuations a little bit, just like partial valuations. I haven't built up full models for them, just kind of like using my template to quickly do some scannings. Some companies that were asked of me to check on, and the other ones I'm kind of like was just focusing on for my own reasons. In particular, I made like a little quick valuation of Home Depot, and then I started one today for Walmart, but I haven't really gotten anywhere with it. I will say Home Depot looks kind of expensive still at first glance, but like I said, I don't really have a solid model for it. But it's not in the dashboard. It may not ever end up in the dashboard. I'm kind of being a little bit more choosy. It's like either I make a full model for the company down to revenue segments and unit parts and everything, or I don't, or it doesn't end up in there. But sometimes I still throw a quick DCF together just because I want to know whether or not something's kind of like a reasonable value of interest to maybe look at. I also did some brief valuations of some other copper producers, specifically Southern Copper, Freeport, McMahon, and BHP. I was kind of trying to compare those against Samphire Resources, the one that I currently have in my portfolio. Those ones, well, I mean, those are three different companies. So like, I think one of them was like slightly overvalued. One of them was decently overvalued, and one of them was kind of about fair value currently. I think it was Southern Copper was the one I think that was about fair value, but I also don't have a full model for those. Either way, just trying to like basically throw together brief valuations for other competitors against some of the other companies in my groupings here. Then also, I also was talking a bit last week also about the kind of industry groupings that I've been trying to take a look at. Other companies that I'm pretty interested in looking at in the near future. I want to do another valuation of LPX. I did obviously make a valuation of that last year, but I'm definitely very, very curious about taking a look at this one again. Let's see, what was one of the other ones that was of interest to me in that same kind of field. Oh, which one was it? Oh, I might have screened it out from this particular grouping. I'm not sure about that, but either way, then there were some of the other industry groupings I was hoping to take a look at. Let's see, back to the kind of the insurance space as we were talking about. Beyond just annuities, I'm trying to take a look at the insurance space a little bit more broadly. And when I was doing through my screenings, these were some of the other insurance companies that did pop up. Obviously, you can see FG and FNF are on here. Let's see, there's a few larger ones like Manulife, as well as Sun Life, but most of them are pretty small, more in just like the single billion range or even the 100 million range. I don't even know feel about these. Some of these, this one says it's a title company. So like I said, this is insurance broadly. This isn't just annuities. So like I'm really kind of hoping to take a look at that space a little bit more broadly. For the insurance housing theme, I've just come across MTG as my next possible play. MTG, was that in here? Or no, I think you just mentioned that ticker before. Let me pull that up. MGIC Investment Corporation, 3 billion. Insurance specialty. Private mortgage insurance, other mortgage credit risk management solutions, ancillary services to lenders. I'm forecasting them at 20% returns, 10% under fair value. Sounds like that should be a pretty large discount rate then. Is there any analysis on the company? A little bit of analysis. They're at least expected to not be shrinking in the near future, at least according to the small handful of analysts that are on it. Not highly shorted, at least some insider holding. Interesting. 3% dividend yield, but still a very, very low payout ratio. That's pretty interesting, or relatively low. Lots of room for yield growth there. They have a theme called persistence, where people are paying their PMI and can't refi out of it because rates are more expensive than the insurance. Interesting. Yeah, that makes sense. There's definitely kind of a large dynamic of that going on with the rise in rates. In a certain sense, the mortgages themselves have become more valuable than the actual like asset of being in the house for a lot of people, depending on the dynamic. So yeah, that's kind of interesting. I would kind of wonder about the sustainability of that, but that definitely sounds like that could be interesting. Let's see, 1.2 billion, or wait, thousands. Yeah, 1.2 billion. I don't know why I thought that was a different measure for a second. Yeah, high net incomes relative to the revenue. So obviously it looks like they have very, very low operating costs. I'd have to kind of see about what's up with that. That seems pretty interesting. Kind of persistent back to the past. So really, really high net income margins, really, really high operating margins. I'm sure it comes down to like how their capital base works. What with them being an insurance company, they probably just have really, really massive financing investings is what I expect. Yo, what's up, man? See you up in here. Here, let me actually pull up in their file. I want to see their like actual cash flow statement, not just Yahoo's arranging of it. Okay. Equity cash flow. Yeah, so 850 or 865 million net income turns into 650 million operating activities. Then they have, yeah, large purchases of investments, but then on proceeds from investments, which for a lot of companies in cash flow statements, like when I'm calculating a free cash flow, for example, for a typical company, I would ignore investments and sales of investments, and I would kind of just assume they net out to about balance for like a manufacturing company or something like that. But if you're doing a finance company, this effectively becomes your capex, is investment payments for it. Seeing Jeff dipped under 30. Yeah, I saw your message earlier. I didn't react to it. I often don't react to messages I wake up to, but you know, I'm pretty happy that I got out of that one. Like I said, I was saying earlier, talking about the DCFs that I kind of have on here, but not like full DCFs built out of that. Jeff is one of them, which is partially just because partially why I ditched that company, because I had difficulty kind of making a model work for that one in my head a little bit. But is what it is. Wake up earlier. It's my weekend. It's my weekend. I am also 3 hours back from you. Keep that in mind. I am in Arizona, and we don't do daylight savings time, so we just switched from 2 hours difference to 3 hours difference for the East Coast, which is really annoying for market hours as well, by the way. Super annoying. It's also why the show here today is technically an hour late for a lot of you guys' perspective. Like, this is the same time that I did it last week from my perspective, but it's an hour later for everybody who's using a daylight saving schedule on their perspective. So yeah, a lot of people say they like it. I think the way it currently is, I think is the more preferable one between daylight and non-daylight. I can't ever remember which one's which and which one's the more favorite one. But I prefer only being 2 hours different from the East Coast because, well, that's market hours. So it's my personal preference is the other half of the year, or other section of the year. This time better for me, EST. Yeah. I mean, I knew that it was gonna be an hour later before I did it, and I kind of was just letting it go to kind of see the differences. Like I've been, shifting the hours around a little bit just to see how things go. So anyway, back to this question I was doing right here. It's basically just trying to like get a look at what I think about their free cash flows. 650 million from operating activities. We will count these maturity of fixed income securities. We're definitely counting these. So yeah, everything in here we would count basically. So adding on to that, but you can see it's actually a gain instead of payments for their investments of that. So that means that ends up being 1 billion, 1 billion or so. Thanks for the stream today. Thank you for the viewership today. Everybody who was watching live or on the replay, like the stream, help us with the algorithm. Subscribe to the channel if you're not already. Join the Discord, link is in the description below. Become part of the daily discussions. Also consider offering any donations to the channel. We have links for that in the description below as well. So anyway, let's look at the financing activities though. That's the next question. We got 323.30 FHLB advance. Yeah, we'll count that as well. All right, so we'll count basically everything here except maybe like this bottom bits. 400, 500, about 500 million. So that's gonna be less than 500 million. So maybe about 500 million or so, give or take, in this year of free cash flows. Oh, I didn't check on equity compensation. About 25 million, whatever. It's small. We can basically ignore that. About 500 million, give or take, 10 or 20 million or so for free cash flow relative to what was the sales? The sales was like 1.5 billion or something like that. Was it 1 billion? Total 1.2 billion. So yeah, that's really high free cash flow yield in that particular year, but obviously that's at the expense of the maturities of securities. The thing about that is, like I said, cash flow from operating activities for a typical company is almost never positive. Like for a manufacturing company, this number is almost never positive unless they sold off a segment of their business. It's pretty much a negative number on almost every cash flow statement. You can see these other two are negative, for example. So this is really more like it balancing out the probably very largely negative cash flow numbers because of the investment cash flows, which is typical for any finance company. So really, you might want to take an average between the two. I guess I can probably assume that all the numbers ended up being relatively similar between it. I think it's actually, we could probably say that the change in cash is a reasonable proxy for a lot of that. Well, maybe, I don't know, because the number they're getting here is pretty significantly different. So I don't know. I'd have to maybe take a look at all of their cash flow, their statements more closely, but it looks like they have pretty strong cash flows. It doesn't look like there's necessarily a disappearing in the ether. The real question I would have is like why they managed to have that kind of cash flow yield. But I don't know. Let me see what they have on their balance sheet. $5.4 billion investment portfolio, pretty much all fixed income available for sale at fair value as one does. Then let's see, out of a total of 6.2 billion in assets, the total liabilities is incredibly small. That's pretty interesting. They're pretty low leverage levels relative to their industry. Interesting. You can assume that they have pretty large unrealized losses on the investment portfolio. I'd have to take a look at the durations on that. Oh, hey, actually came right up on it. Investment portfolio, operating companies versus the holding company. I'd have to kind of take a look at the structure they have between the operating companies as well. But yeah, this looks like a pretty interesting company though. Looks like it's pretty profitable. I'd be curious to see what dynamics is giving it that, and maybe it's just over those 3 years that they look that profitable. Maybe if I look over a longer period of time, it would kind of balance itself out a bit, but hard to say. Any other companies you guys want to take a look at? Was it, what did you say? It peaked RJF, but already got Schwab. RJF, let's take a look at them. Then another one of them capital market players. Yeah, I'm definitely less news about them, but yeah, they've come down pretty significantly. Second. Appreciate looking at them on the stream, of course. One of these days, I'm going to give you something of value. Hey man, keep watching. If you're one of my most regular watchers, that's pretty valuable to me. So, so what else you guys want to talk about? Any other tickers you want me to take a look at? Or I can talk a bit about one of my other companies. Every video, every stream. Yeah, I super appreciate it. That's the thing, is like, you know, I may not have a ton of subscribers, but I think I've got a nice little ring of pretty loyal subscribers. So there's that, you know, is what it is. So as I said, I'm definitely looking to do my F&F video here. Probably, like I said, I'm hoping to maybe rush it out this week, even though I've been trying to do every other week for valuation videos, but I partially just want to get this done because it's kind of paired up with the FG video. I'm basically gonna try to have them tagged with each other so that people watch them together a little bit. But because as I was kind of saying before, I was originally trying to finish up my model for F&F, and obviously FG being like 1/3 of their business, I kind of had to build my whole model for FG first. And so I was just like, well, let's just do a video on its own. And so with the F&F video, I can basically now just talk entirely about the title industry. And then when I get to the annuity part of the business, I can just say, go watch my FG video and all that. But what with the F&F video, I have been taking a lot of closer look at the mortgage market and trying to see where I think things are likely to stabilize in terms of the mortgage market. I've been working on themes I care about. I'm checking out them right now to see if I've got any other tickers. I went through about 20 this week. Talk about Jordans. What's up, Mr. Beast? What about Jordans? What ticker? Which company are you talking about? Let me pull this up. I was gonna half starting talking about some real estate stuff. Nice shoe market on fire. Fine, thanks you. I was joking. Oh, we're talking about like Jordans. Say the private. It's like, I was like, is there some like weird company called Jordans I don't know about? But anyway, I've been trying to like take a look at the real estate market. Like I said, try to think about like where I think the mortgage industry is going to maybe bottom out versus where it's going to go sort of in the long run. In my F&F model, some of the information that they have in their 10K includes some government projections of where the overall mortgage market is set later to go, which they actually do have projections for 2023 and 2024. Looking back through the projections for those same numbers they had in the past, they often do deviate a little bit by maybe up to a few hundred a billion relative to that. But either way, they seem to be expecting the mortgage market in 2023 to come down to about 1.9 trillion versus 2.2 trillion in 2022. But then they seem to be expecting it to rebound back up to 2.5 trillion in 2024. However, I would note that, like I said, there's usually deviations from the projections versus the actual historical numbers. For example, if looking at the same projections they had in 2021 about what 2022 and 2023 were going to be like, well, they basically had the same perspective where they thought 2022 was going to be a dip down significantly, and then it was going to bounce back up by about a few hundred billion in 2023. So then when I came and saw the 2022 numbers versus the projections that are now in place, it looks like they basically pushed that bounce back up. They pushed it out by another year. So who's to say that maybe it doesn't actually, maybe 2023 is a little bit worse than they expect, and then maybe 2024 is closer to the way they expect 2023 to be, and then maybe 2025 is actually when it bounces back up to maybe like 2.5 trillion or something like that. The UBS done deal. Let's bet about the market reaction. Yeah, I mean, it'll be interesting to see how the market reacts. I definitely think it's possible that the market continues to move upward a little bit here in the first couple days of the week before we go into the actual meeting. Um, themselves aren't buying the stock. Let's say take a look. So if you kind of like take a look at the overall market right here, I have the volume weighted average price, which is a metric I've kind of been becoming a bit more of a fan of, because I think it gives you an idea of like where the people are in terms of the overall market. The volume weighted average price, which is this kind of like light blue line right here, tells you that basically if you had purchased every dollar within the market weighted at the volume it was being bought and sold at, where would your average price be? And you can kind of see that like where it traces back above that line is when basically the average market participant since the start of the year, since the end of the year, has effectively reached a point where they're profitable, and they might be like, oh man, I've been down so long, now I want to maybe sell. And we keep tracing back along these lines while we maintain this kind of level of waiting for something new to happen. I definitely think it's very, very possible that we will continue to trend upward because we're still basically below that point a little bit over the next week or two. Just some thoughts that I've been having a little bit over literally the last few days. Someone know Maple Story? That's a game I haven't heard somebody mentioned in at least a couple of years. I know of Maple Story. What do you have to say about it? Yes, coming back into the mortgage market discussion though, I did kind of put together these few different metrics on the Fred website, just thinking about like where maybe the mortgage market might likely to be relative to kind of historical numbers. I tried to basically only focus on metrics where I had larger historical data going back several decades. So here, for example, is new one-family homes for sale in the United States over new one family sales sold in the United States, and I did it times 12 because one of those is a monthly metric and I wanted to make it roughly equivalent. So basically this gives you an idea of approximately how many homes are for sale relative to the amount of homes that have been sold within that same trailing year. And you can see it's like a ratio number. So you can see that in general, it seems to be hovering in this kind of like maybe 0.5 range. It's like the longer term average going back like 70 years, 80 years right here. And you can see that we're currently still a bit high in terms of that. We're still at about 0.62. So based off of this metric, you could argue maybe that the overall sales relative to the amount of homes that are currently for sale on the market relative to the amount of homes being sold would still have to maybe drop about 25 to 33%, something like that, to get back closer to a longer term average. That doesn't necessarily mean that it's not going to, that's where it bottoms, because obviously it can go lower before reaching an average. Average doesn't include everything that's below average. So that's just one particular measure. Then there's also median number of months on sale market for newly completed homes. I didn't have to do any really calculations for this. The Fred website already has this one in line here. You can see like the median number of months that a house is on the market is, it may be on average, maybe in this kind of like 4s range over the longer term average, below 5. Maybe in like 4.5 kind of range or something like that. So based off of this metric, you can see that we're currently still at only about 2.4 months. 2.4 months as of January anyway. This is a little bit of lag in some of the data there. So based off of this, you can see that there, on average, there actually isn't that many homes on the market relative to how fast they are leaving the market. So from this particular perspective, you can see that there's actually still significant demand backing up the overall market. Not all these metrics necessarily argue that we would have to go into some major decline. That's kind of the interesting thing about this, which I would say bounces off against the projections saying that maybe next year could be a hotter year. I would say that would heavily depend on the interest rates. We've seen actually a pretty significant pullback from the peak mortgage rates over the last 3 months, and there has been a large acceleration in the overall sales in the last month or two relative to like 4 or 5 months ago. For my climate change theme, I like PGTI, shatterproof windows for more violent weather conditions / storms. My affordable housing theme, I like PATK, Patrick, we've looked at that one, and CVCO. Geld is a kind of similar of PATK. Yeah, I mean, obviously we looked at PATK before. I think we at least looked briefly at GELD. That sounds kind of familiar. Let me take a look at the PGTI one though. That could be kind of interesting. Also, hey to Hearts on Twitch. I saw you there. Yeah. So what was this? You're saying reinforced glass? type products. Impact resistance, aluminum frame, windows, and doors. That could be interesting. And I mean, that goes beyond just the climate change theme. That would still fit in with the overall kind of building theme that I'm trying to build with as well. The aging buildings and overall infrastructure and new housing demographics trend they can kind of fit in with that one as well a little bit. Of course, it's my tickers, all of that. Yeah. Let's see. Oh, it is PATK. I did like that company when I was looking. I thought they had a pretty nice, well run setup for themselves. It was really just like the large cyclicality of that business. Maybe not super interesting at the time, and obviously they weren't the greatest price. But I'm pretty sure they had come down relative to my estimates as well. So I think I was valuing them like in here kind of range or something. So they did come down for a while. And I'm pretty sure people were yelling at me that I should look at it a bit. But either way, could fit in with a civil unrest theme too, along with RGR and SWBI. That is a fair point. That is a fair point. I'm admittedly, I obviously am invested in Smith and Wesson, but that's not really, I wouldn't call it necessarily a civil unrest theme, but that is a theme. That's a theme that you could argue for, that it still fits in with. Because like my argument more for Smith and Wesson comes more from like a contra ESG kind of philosophy. There's a lot of like funds, that just look at Smith and Wesson as like a bad company or whatever. And in my opinion, they're far from it. So, and not just in terms of how they operate. Like I think they're a benefit to society. That's my personal perspective. But hey, so but the civil unrest is an arguable theme. I don't necessarily know how. I haven't really looked into that idea as a theme specifically, but I don't know how crowded it is. But because that's definitely something that I think was probably more crowded a year or two ago for sure. Smith and Wesson was probably about a part of that. Just buy some drink and think about that. Yeah. So anyway, what was the other one you said there? JELD. Which one is that? Geldwen Holding. I don't know. That doesn't sound as familiar now. Designs, manufactures, sells doors, windows primarily in North America, Europe, and Australasia. Company offers a line of residential interior and exterior door products, including patio doors, folding slide wall systems, non-residential door, wood, vinyl, and aluminum, and wood composite windows. This is pretty interesting. Yeah, this one can go pretty well alongside PGTI. And I think this one looks a little bit broader. It looks like it's going beyond just the security aspects, but looking more into like also just kind of general building. Which maybe that's where I recognize the ticker from. Maybe I've seen it in like a screening for building products before. CVCO, let's take a look at that one. Bro, you trust me, I know that. Hey man, I trust myself and my mom. That's about it, Cavco Industries, residential construction, produces and retails manufactured homes primarily in the United States. I will say I'm really not hoping to focus too much on builders. I looked a lot at builders last year, and honestly, that definitely was like, you know what? I'm just looking at the space. I definitely think there's still a lot of room for a lot of pain there. And on the demand side, I think, as I was just talking about the housing, I think there's potential for it to bounce back to a certain extent, but I still think that they're way over inventoried to a certain extent for a lot of the builders I was looking at. So I'm a little bit less interested in the builders. Like I said, I'm more focused on like a little bit downstream from that industry, thinking about like the replacement products post build, which is why like, yeah, the other things like the JELD and PGTI and LPX and ATKR and all the other ones and stuff like that. Definitely been trying to like look at that. And speaking of LPX, I want to pull LPX up. Because like I said, I've been seeing them on the screens. That's why I've been kind of looking at them, but I haven't really looked at them on the chart as much, thinking about like where they've come. They definitely have come down pretty significantly from where they were there in 2020, the January boost, back from where they were in 2021. They've come down pretty significantly, but still kind of in this like holding trading period right here. The PE ratio, weren't they at like a lower PE ratio? I remember them maybe being like the 3s before. So the PE ratio has come up. I'm assuming the earnings have come down a little bit relative to that. I mean, their prices shifted a little bit. Maybe the earnings have come down a little bit.
in the electrical space, where I love ATKR. Yeah, yeah, definitely. All electrical fits in with that theme pretty much as well. Do you think the ridiculous ROICs, ROEs will attract more and spike the business cycle? I want more exposure there, but there aren't cheap companies. Um, well, see, that's the thing is like the ROIC comes after the fact. In a certain sense, the time to hop in on cyclical industries is actually when the ROICs and the ROEs are low, because that's really when the space is cleared out of people. So it's like I think it's too late for a lot of those companies. I think we kind of have to wait for the returns to come down. Which I mean, like you'll see, like here, like my initial reaction when I came to look at Louisiana Pacific was to think, okay, how far has the earnings come down from when I last looked at them? I want the earnings to come down because not because the business is bad, but because I need that cyclicality flush out. It's like I really do want to take a look at LPX, but I need all the people who are hyped up on the 1.4 billion that they earned in 2021 to be gone. And so like throughout 2022, they've shaken that off, and they'll probably shake off a bit more. We'll see what the yeah 28% revenue decline expected in 2023. Woo! Yeah, so I might want to build the model with those expectations in place for LPX. But I might want to wait until midway through 2023, or more like maybe towards the end of 2023. We might have to wait for that. But yeah, this thing is like, to be honest, is like it's tricky because you want to buy companies when they look bad, which means when they have low returns on invested capital, when they have low margins. It's like really you want to buy the company that has 1% margin, but it really is going to have a 10% margin, but everyone's convinced that at best it's going to have a 2% margin, so that's kind of the tricky. Wait, isn't that one Buffett was buying? Yes, yes. I made the valuation about this one last year, and then Buffett was buying a bit of it after the fact. I think he's buying it a bit hot. I don't know. It's my personal opinion. Frankly, Buffett has kind of made a bit of a habit of that. Like he's bought in multiple companies that I valued after the fact that I thought were expensive. Like I sold out of HP, and then he bought into HP. I sold out of Store Capital. He bought into Store Capital. I didn't buy into LPX, but I said it was overvalued. He buys into LPX. Like I don't know, Buffett keeps buying things I think are overvalued, but I mean, hey, whatever. He's the goat, and I'm not, right? So I'm not gonna. But yeah, no. Either way, like I said, I'm still very interested in looking at this company, but cyclicality is gonna hit it. So like 2.8 billion on the revenue. Let me see what kind of like operating numbers they're expected. To pull up in ticker, it'll give me. Give it a second. So yeah, they're expecting EBIT to drop from 1.2 billion down to like less than 300 million in 2023. 78, almost 80% drop in operating income. That's pretty rough. Pretty rough. Which, so think about that in terms of multiple. It's like if that were to occur and the price was to stay exactly where it's at, well, then that means this thing is going back over 10. Anyway, you mentioned the acquirer's multiple. I have never read it. I considered reading it at one point. Like it was like, there's like a bazillion finance books. And I'm like, I don't want to read this one, this one. So it's been recommended to me a couple times before. I've considered looking at it. And like I'm aware of like what the acquirer's multiple is, sort of, or at least what most people call the acquirer's multiple. So I don't know. There's reasons why I haven't gotten around to it. But I don't know. I might eventually get around to reading it if just looking at it. Like Magic Formula, but slightly more effective in good markets. Yeah, because like the acquirer's multiple, like at least the way I've heard people talk about the concept of it, not necessarily related to the books. This is the thing is like I've heard like the acquirer's multiple in general is EV to EBITDA. That's what people typically call the acquisition multiple, because basically it's how much does it cost relative to price to add the operating earnings to your business, and it doesn't take capital expenditures into account, which is why it takes out the D&A. Which I'm not a huge fan of EBITDA personally, because it takes out the DNA. Personally, I think you need to leave DNA in there to have a more realistic answer of like what the operating earnings of the business is. But that's a philosophical disagreement with people about things. Well, people like the EBITDA multiple because they look at it as a big company wants to acquire a small company, which means the capital expenditures are going to have almost no effect on anything, and so they go with the EBITDA multiple. But like I said, I don't know how much the book Acquirers Multiple focuses on that necessarily. So that is what EV to EBIT is the Acquirers Multiple. Okay, cool. That sounds like they're smarter then. That, cool. Like I said, it's like I hadn't read it partially because when most people talk about the Acquirers Multiple, I hear them talk about EBITDA versus EBIT, and that's kind of a big difference in my opinion. So, but yeah, and Joel Greenblatt likes EV to EBIT as well. It's kind of got a similar. It sounds like it does have a similar concept to the magic formula, which is kind of neat or whatever. But either way, yeah, it's more of a pricing concept more than a pure valuation concept, which is another reason why I'm less enthusiastic about those types of things. But it's worth thinking about. There is flaws with the EV to EBIT, I will say. EV to EBIT excludes taxes. In different companies, different industries have significantly different tax rates. So you're going to see differences across industries due to the differences in tax rates. That's one major difference right there. So gotta keep that in mind. There's definitely major differences. I'll say once again, if people are watching live on the replay, please like the stream. Please like the stream. Help us with the almighty YouTube algorithm. Please subscribe to the channel if you're not already. Also, join the free Discord. Link is in the description below. Come be part of our daily discussions that we have of what's going on in the market. Also, other links down there for donating or adding to the channel. You can add those links as well. I think it beat the magic formula by 4%. Did it? That's pretty interesting. I'd be curious to take a look at the differences between it. I'd be curious to see whether or not they're actually measuring over the same time periods or with the same data, though. That's another thing. It's like people could be like, oh, this number beats this time over this time frame. And it's what it is. Also, I mean, it's worth noting that, I mean, the magic formula has its limitations partially because of backtracked data. It's like you can only actually use the magic formula past a certain date. And wasn't the Acquirers Multiple written like a little bit earlier? I can't remember what year it was written, but like I feel like I remember that being an older book, isn't it? Multiple. I don't know. I can't remember. Like I said, I've never read it, so but I thought I remember that being a bit of a Acquirers Multiple book. Come on, somebody. Oh, maybe not. No, it sounds like it's a bit more recent. It might have time for a glance at LPRO. Yeah, sure. Okay, maybe I'm wrong about it being older. 1983 to 2012. Okay, maybe it is a bit older than Greenblatt's then. Oh, okay, never mind. I pulled up on a page that says 2017, but that's like the edition of that book that came out. So my bad. LPRO. Let's take a look at LPRO. Open lending. Okay, yeah, I would say this sounds familiar. Sounds like something I've looked at before. The ticker sounded familiar at least. Credit services. Enables lending basically as software for small banks and credit unions to underwrite auto loans differently. One, it's too new. I need to understand what their world and what they're going through. Software to loan. No loan origination. It's just software. So they got them kind of like categorized a little bit awkwardly. That does happen. Provides enabling risk analytics solutions to credit unions, regional banks, and finance companies. So this would be a company that might be able to profit from smaller financial institutions without necessarily getting the same type of risk exposure, possibly. Maybe. That might be a bold assumption. They might have the same cyclicality by being tied to them, so that might not be entirely true, but they do R&D. They do R&D. R&D is growing. That's nice. What size is this? Very small. 846 million. Yeah. Oh, you know I always want them cheap, my man. That's what we do around here. 100 million. Almost no investing cash flows. That's software. It's kind of what you would expect. Financing relatively low. Free cash flows 100 million. Do they have a large stock base? Not really. It's okay. So yeah, about 100 million free cash flow in the most recent year. That seems about right. Those seem to be similar. What's the share count like? Uh, could be something. This could be something lazy. I'm pretty sure that's another one that I think I've taken at least a glance at before. Let me see. We'll look at that in a second. So yeah, they're expected to have a big shutdown today. They're probably expecting a lot of banks to be cutting their excess costs a little bit. So that's probably what they're expecting for that. But they seem to be expecting a big bounce back next year. It's interesting to see they have a decent handful of coverage though. It's into the double digits as far as analysts for such a small company. That's kind of interesting. Let me pull another thing up. That's pretty interesting. Share statistics. Some shorting, nothing too crazy. They got some insiders, no dividends, but we probably don't want them to pay dividends anyway. More cash than debt as it lists here. The lease liabilities might counteract that, but we'll assume that's true. Hold on. To Pro 2023 EBITs. Yeah, they're expecting about 40% decline in operating income next year. Well, this could be interesting. We'll open their website. Something happening? Are you guys talking about lazy? Or were you guys still talking about open lending? I was kind of going down this rabbit hole personally. I think they're just peak market and pulling back in response to mean reversion, very possibly. I go so deep just to get to 10K. They have a presentation. Total certs. Yeah, I got you. Sorry, it's just like I look away from the chat for half a second, then I get confused sometimes about what's happening. But that's good. It's good. I like you guys talking to each other. It helps. So they're talking about their certifications, the certified loan originations that they're doing here. So they're not doing the loan originations themselves, but like their software is profited based off of the amount of certifications that go through, is what it looks like, if I'm understanding this correctly. And then they are charging basically a fee based off of the amount of certifications that they handled with their software, is what it's sort of looking like, if I'm understanding those metrics. Let me go there. Explain to me what you do, guys. Explain to me what you do. Open Lending Quarters, headquartered Austin, Texas, provides loan analytics, risk-based loan pricing, risk modeling, and automated decision technology for automated loaners, blah, 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 which enables each lending institution to book near prime and non-prime auto loans coupled with real-time underwriting loans, blah, 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 blah. Give me an overview of like how this actually works. We are leading provider of enabling They refer to herein as automotive lenders make consumer loans to undeserved. Yeah, they're an underwriting facility, I think, almost like social credit score. Okay. Yeah, so they match customers to the lenders, basically like taking a bunch of prime and near prime people that may not be able to get their credit, and basically saying, yeah, these people can take the loans, and then they take a fee based on that. Like you say, they're not exposed specifically to the loans themselves. So like, I'm curious, how the financial institution uh handles the results. Like it's like I'm wondering how they're like, whether or not the loans are actually successful or not, or whether or not they end up being delinquent or not. I'm wondering how that ends up affecting the metrics, or if there's like, or if that just affects how much the company continues to buy from them or not. I don't know. Might have to look pretty deep on this one. It's like, it sounds like it's an interesting company, but it still might be a little bit complicated to figure out some of the details of like how the revenues, how it is that they determine how much that they should be paid, how the financial institution determines how much they should be paying them in particular. So, but interesting company though, interesting company. So let's come back over to Lazy. Go back over to Lazy. Definitely not super interested in dealerships, but it looks like they hadn't had too crazy of activity in the recent several months. Yeah. It's actually pretty interesting to see how well they've maintained their earnings compared to some other companies. That's pretty interesting. Yeah, no, I mean, like I said, like I'm not sure what the relationship would be for that. It's just because, like, it's like the bank usually is like, they do their analysis and then they say, well, we expect to have this many losses, and that is what it is. It's like, it might just be that the bank themselves assesses the results based off of that, and then they just have more or less demand for them based off of that. But yeah, I don't know. I'm not. It might be hard to say. I probably have to read most of the 10K to figure it out. So, uh, like, because it's like I'm sort of looking at here. It says average profit share revenue per cert, and then average program fee revenue per cert. So it's like I have to figure out exactly what they mean by program fees. Yeah. And then it sounds like there's going to be a difference overall in the either the pricing or the overall demand levels compared to new vehicles versus used, direct versus indirect, refinance versus non-refinance, which is, all those things sound at least kind of similar to like the way the dynamics work for the title insurance thing for F&F. So like that at least sounds somewhat similar for that part of it. But yeah, the figuring out the profit share and the program fee dynamics, like that sounds like something might have to read a little bit deeper to figure out about. But either way, yeah, I'm not gonna do that here on stream right now though. But yeah, so anyway, we are here at about the hour. Might come to relatively near the end of the stream or something, unless you guys have more stuff to look at. If you guys have more specific tickers, we can take a look at them. Or what are we thinking about the market on Monday? As I said, I definitely see reason that the market could continue to be relatively optimistic for the next day or two, and then the market obviously pricing in the potentiality for rate pauses means that maybe if we do get the 25 basis points, maybe the market will react negatively. So maybe it's 2 green days for Monday, Tuesday, and then we go to red for the rest of the week or something like that. Possibly, I don't know. Negative 25%, negative 25%, 6%, 6%, 4%. First 5 years of forecasting that I'm modeling, and with this guess, I land at about 6% below fair value. Interesting. What reason? What reason for what I was saying, or what he was saying? Because I was talking earlier about the fact that I think the market would be maybe Bitcoin to 1 million, probably. Probably. So probably. Hoping for more down days. I love red when I'm buying. Oh yeah, I mean we all hoping for red. This whole channel's favorite color is red. I'm pretty sure. But yeah, I'm just saying what I think. The market. Yeah, I was talking a bit earlier. The kind of like one of the few metrics I kind of really like in terms of like volumetric metrics is the like the volume weighted average price, the VWAP as it's often called, which you have in this light blue line right here. Whenever the market tends to get back above that line, that basically means the average market participant from whatever the anchoring point is, which I'm using the start of the year as this current one. You can use different ones. You could use the one since SVB crash. You could use since or start since the end of 2021. You can also use the start of the year. I've used different ones. Point is the market seems to get a little bit seems to lose steam relatively quickly after whenever people start to get to a point where they're no longer in the red. Whenever the average market participant eventually is no longer in the red, a lot of people are like, damn it, I'm getting out. You know, that's kind of like an often problem. And it takes a bit of effort for the momentum to eventually build past that and to go back into a bullish market. We've been kind of playing this little like game a little bit for a year and a half, and I just think that the current dynamics say that we're probably more likely to continue to be doing that game. And since we're still slightly below the overall weighted average price, then I can still see people willing to buy for the next couple days or so. That doesn't mean it's going to do so or not. I'm not really a short-term trader despite that. That's just what my personal perspective is, that until we have a specifically negative thing, I think we're more likely to continue upward towards that volume weighted average price than not. So next 2 days, my expectations are maybe it'll be green. Then it'll maybe be red a little bit after that, assuming we have 25 basis point hike, which is what I expect. Great stuff as always, Myas. We're on about 1 minute lag from chat to when it shows up for you, just in case. Thanks for all your time. Enjoy the week. Yeah, I was pretty sure that it was coming in at a little bit of a lag. My internet was being a little bit funky, a little bit there, but I thought that was maybe what was happening there. But like I said, I'm basically bringing the show to a close, so that's fine what it is. Sometimes my internet decides to start making the software get the lag come through. But yeah, so I guess we'll call it there pretty much for the show. Like I said, we'll see how the week goes. Maybe I'll have the FNF video this week or not. If not this week, it'll be next week. Maybe, like I said, maybe it'll be LPX the next one after that. I'm not sure. Still looking at other companies, and I am still curious to take a look at some of those tickers you guys threw in there today. I super appreciate you guys coming into the chat. It was really awesome that we had you guys pretty much from the get-go, and more of you guys showed up as we went. So I will catch you all again next week. Good luck to everybody in the market. We'll see how Mr.